There's a specific formula billion-dollar companies use that most CFOs have never heard of, and I'm about to show it to you. I've put together some commonly overlooked financial ratios and tests that every single founder and CFO should be tracking in their company monthly, if not quarterly. These are the biggest risks that hurt companies in the medium to long term. And I want to show you exactly why companies continuously overlook these things and sometimes even misrepresent the business's health to investors, which later on down the road leads to lawsuits. This is something I've seen. It's not pretty, and it's something that every founder should completely avoid. So let's get right into it. Overall, you have to understand that industry specific benchmarks are completely misleading. They're headlines. The same way most people don't trust the media today is the same way you should be as a founder when it comes to seeing people's revenue numbers, exit valuations, or acquisitions. Most benchmarks that we see online do not reflect reality for the median. I'm not going to say the average because averages get abused and manipulated all the time, but let's just look at median and mode. Industry specific benchmarks don't work most of the time because how am I going to compare the benchmark of a SaaS company that does $1 billion a year to a SaaS company that's at 1 million a month? There's no comparison, but they get bunched into the same benchmarks. And you have to dive deeper if you really want to understand what's going on in those businesses. The idea that SaaS companies should have 6 months of runway is meaningless. Companies in the same industry have different risk profiles, cash dynamics, and exposures. You have to stop Googling benchmarks when you're talking about industry standards. Or if your CFO brings up a Googled industry standard, you're in trouble. You might want to have a new CFO, and that's something we provide. You want to calculate your reserves and your runway from a first principles basis. So let's look at why generic benchmarks don't work. You can have the same industry SaaS, but if their average revenue per account or per user, ARPU, is over $1,000 a month and one has under $25 a month, the retention metrics that you're comparing don't matter because it's a completely different ICP. So just because a SaaS solves the same problem in an industry like QuickBooks versus NetSuite doesn't mean that the customer profile, cohort segmentation, or retention is going to be the same. But people will still benchmark these statistics all at once. And revenue concentration is a huge problem when it comes to measuring cash flow and the cash needs of a business. An enterprise client consisting of 60% of the revenue for a business is not the same as a business with 500 small customers. It's a totally different risk analysis. Here's the reality about small to medium-sized businesses and mid-market. You're not really considered small, medium-sized, mid-market until you're at approximately $5 to $10 million a year in revenue. And what does that mean? It also means that your customer concentration risk should ideally be less than 10%, but you're golden if no single customer exceeds 2 to 3% of your revenue. These are the companies that are backed by VCs, investors. They have, a decade of operating experience, at least across all the partners. There's a lot of sophistication that goes into these types of businesses. Sometimes there isn't, but if you can make sure your customer concentration is below 2 to 3% of revenue per account per user, you're in a really good spot. And that means that you have to think about your pricing, right? Maybe you're pricing too high. The market really wants what you have, but you've overpriced so much that you're actually creating more customer concentration risk. So that's something to consider as part of the strategy of running the business. In enterprise SaaS, it can be 10 to 15%. So obviously it depends on the SaaS that we're talking about. And this is why it's so important to ignore generic benchmarks. Unit economics also change depending on the business model. In e-commerce, your fashion brand will do 30 to 40% versus electronics that does 11%. So a single e-com benchmark is useless, right? The way you calculate things and the way you calculate customer concentration also depends on the unit economics of your business. In SaaS, it's a lot easier to simplify because we could say, okay, SMB mid-market versus enterprise, but in e-commerce, it completely shifts the focus and you have to think about things completely differently. Macro labels don't actually protect you. Just because you're an enterprise SaaS company doesn't make you safe. 32% of recent shutdowns were from SaaS companies in the enterprise space. So being in a good industry doesn't remove the company specific risk that is associated with your brand or with your business. So just because you service enterprises doesn't mean that those contracts can stay around for a while. Something can happen. There could be a shutdown and then you lose all your customer contracts. So when you calculate your reserves, you need to think about the top customer percentages. So where is the concentration of your top customer percentages, and what are they for? What do they do? Who are your top 5 customers, and how much time does it take to replace each customer? What are the contract terms with those customers, right? If you're a self-service SaaS, charging 50 to $100 a month, it's not going to be the same as charging $200,000 a quarter for an enterprise level company. It's a different game completely. You need to look at contract terms, cancellation terms, payment terms, and renewal rates. All these things factor into the calculations of how much reserves you need. From a fixed cost structure standpoint, and we're going to go into this, payroll as a percentage of revenue is incredibly important, and it depends on your business model and the industry. That doesn't mean you should fall for the generic benchmarking, but you should understand that there should be a maximum cap on how much you're willing to spend on your core team, on your payroll. Rent and other fixed costs need to be kept in a limited fashion, in a way where you're thinking as a founder, how do I make sure that I have wiggle room where I can extend rent for a few months, maybe with a good landlord, or because you saved on rent for running your company. Minimum viable team size is another important consideration here. You need to think about your headcount, not as a function of who do we need right now, but on a structural level of how many customers before this customer service manager or account executive gets burned out. So thinking about the ratio of how many sales a closer can make, how many clients can account executives actually handle. These are very important statistics to help you consider your budgeting and your growth plans. The next question is, let's say you want to scale aggressively. How quickly can you slow down or stop the burn that you're creating as you scale aggressively if things don't go the right way? When we look at Facebook, they dropped $12 billion, I believe, on the metaverse, and it cut their operating cash flow in half. A year later, now they're on top of AI. They cut their burn, they cut all their excessive investments, and now they have, I think, $70 billion in free cash flow 1 to 2 years later. That's insane. That shows that they can reduce burn fast because they have good contracts, they have good notice periods, severance obligations, and they lock in their vendors for a long time. When it comes to churn, your actual churn, your net churn after you add more customers versus your true return rate are 2 considerations you need to think about. When a customer churns and then comes back, what does that ratio look like? Because this will help you understand how much reserves you need to keep that customer or get that customer back in the loop. Then we need to think about revenue reversibility. So how quickly can your revenue disappear? Do you have sticky contracts? Do you have certain network effects or intellectual property that makes it hard for a customer to say that they're going to the next bidder down the street? This is where you want to do a weighted score on all of these risks. You want to assign weights to concentration risk, churn, contract volatility, and cutting speed. So how do you reduce that burn? That's what I mean by cutting speed. When it comes to calculating your weighted buffer, you want to just think about which scoring system to use to say, okay, this is not as important as this, and it's not as important as this, or it doesn't affect the risk of the business as much in terms of maybe revenue, headcount, cutting burn, whatever it is. You want to think about assigning scores to certain variables and then calculating and stress testing them. And the way we do that is we convert them into months of reserve, and we convert them into a single target for the company to decide how much buffer they actually need. So the best way to do this, or not the best, but the way we like to do it, is we like to make a base case, a base reserve, saying, okay, we want this amount of burn put away in savings at a concentration buffer. So the expected impact of losing the top customers times the replacement time, and I'm going to get into it. And then we want to add a volatility buffer. So we want to calculate the variance in collections, cancellations, and returns. This is where cash conversion cycle management becomes crucial. And then we actually want to operate the model that we establish. We want to stress test monthly with real data. We want to update the weights. We want to create reserve targets as a percentage of your mix, concentration, and term changes, right, with all your customers. We want to do scenario planning, do a worst case, base case scenario, right, the most conservative versus the most aggressive. And then we want to tie hiring and spend to the reserve target, not industry averages. Because if you aim to be an industry average, you're going to fall behind. Everybody who's running a successful company that I know wants to be the industry leader. There's no point in running a business unless you want to be the industry leader. So that's how you have to do it. You need to set the standards internally and they will reflect externally. So let's move on to the zombie zone. The zombie zone is this dangerous period when companies have 3 to 6 months of runway and they just start making terrible decisions. They somehow grow and then they stop and then they grow and then they stop. And it's just this endless cycle, feast or famine, where they just constantly make mediocre decisions that just keep them trudging along. And they have to act decisively, in my opinion, to actually avoid this or escape the zone. And most businesses don't even realize that they're in the zombie zone because of their customer concentration risks. So here's the problem. In 2026, it's going to take you, according to the media, 23 months to actually have a full fundraise. This is public data. If you're caught with 3 to 6 months of cash, it means you're either too scared to invest in growth, you're too broke to pivot, or you're too proud to make budget cuts. You're not willing to have hard conversations with your team. You're not willing to let people go. Cash flow kills 29% of SaaS startups. Waiting for capital is a miracle, not a plan. You shouldn't wait for capital to run your company. You need to make sales in your company. I tell this to founders all the time. Go make sales. Go produce a system that brings you customers that you can then use to show investors that you've de-risked the business because you know what your customer acquisition costs are, the time. You can prove that you know how to manage cash flow. This is why founders get stuck. It's because they don't understand the timelines associated with the money they have. A founder will get a $500,000 check for their seed and then they just slack off. They don't really care anymore. They're like, oh yeah, now I'm good. I've got cash in the bank. You don't have cash in the bank. You don't have as much time as you think. And once you start thinking in terms of time measurements instead of financial measurements, things move a lot better in the business because the management team and all the people working in the company have a different way of approaching it. This is where companies can get incredibly paralyzed and where every dollar feels risky and you get scared to reinvest it back in the business. And this is why teams drift. I've seen consulting firms spend 15 to 20 hours a month thinking about cash management instead of client work. So the clients aren't getting the results they paid for, and they're probably not paying the firm because they're like, where are my results? And then the firm is spending all their time trying to chase the client to get paid. This is a very common issue in consulting. So they pass on major contracts or even new sales because they're like, oh, I have too many clients. But the current clients they have are like, oh, I don't want to pay you the full amount yet, or I'm going to keep delaying you because you're not fulfilling. But you're not fulfilling because you're too busy chasing after all the money that all your other clients won't pay you. This is why 3 to 6 months of runway leads to bad decisions, right? And then in e-commerce, you'll have more growth, but it'll tighten up your cash position. Your inventory and marketing outflows or outpaces the inflow in the business, the revenue coming in and the profitability of the business itself, and it starves the business. This paralysis drains time, morale, and it makes it hard to negotiate from a leveraged position with lenders or investors. So this is a good rule of thumb. You either have 12 months of runway or you have to make a hard decision right now. Top investors recommend raising for 24 to 36 months as a safety net because capital takes longer to secure than expected. Most founders think they can do a raise in 6 to 9 months and be done. The reality is it might take years to get all the capital that you want. And this is a reality that most founders just don't want to face. This is why it matters so much. The zombie zone destroys your optionality. You miss the contracts, you underinvest in growth, and you make reactive decisions when it's too late. Delayed decision making increases dilution in your business, it reduces your business's valuation, and it exhausts your team. So this is what you can do right now to fix this. You have to calculate your true runway weekly. You need to include costs that are committed, realistic revenue, not what you ideally want, not what the TAM says or the SOM or the SAM or whatever. You want realistic revenue and your working capital needs. You actually have to think about your assets minus your liabilities, and we're going to talk about that later. You need to decide in the next 2 weeks, if more than 12 months of runway exist, how am I going to invest with discipline in the growth channels that have a clear payback? Because if you already have 12 months of runway, it shows that you have product market fit, and now you need to be smart with your capital allocation decisions. If you have less than 12 months, choose one decision and go with it with full force. You either raise your prices, you cut your costs, you pivot the business, you sell the business, which takes time, by the way, or you wind down the business. There's no other way around it. You need to think about this very objectively, because running out of money doesn't help anybody. It helps absolutely nobody. And if you have a losing business, get out of it now. The way you can sustain a negative position is by raising proactively. You want to raise to have 24 to 36 months of runway. Because if you're stuck in this cycle of constantly raising, you can't actually run your business with peace of mind. You're constantly thinking about the next check that comes in, and you're actually a salesperson for investors instead of a salesperson for the product or service that you built to actually run the business that you wanted in the first place. To cut your burn fast, you need to eliminate non-essential projects. I talk about this at length in some of my other videos, like my bookkeeping guide. You need to renegotiate vendors, office, tooling. You need to stop hiring, move to more variable and contract labor, more off-balance sheet items. And to improve cash flow, you need to shorten the time that it takes to get money. You need to have upfront deposits, milestone-based billing, or incentivize your clients to prepay. These three things can put a lot of cash in a business in a very short period of time. The way you can do cash flow improvements depends on your relationship with your vendors as well. If you have a long-term vendor, you have a good relationship with them, they'd be willing to take the risk of giving you a line of credit. If you don't have good relationships, or you're somebody that nobody wants to do business with, but they're forced to, it's going to be very hard when they smell blood in the water. For e-commerce businesses, think about tightening your SKU count, shift to purchase order financing or consignment, like factoring, and reduce inventory cycles. That means maybe buying less, buying in bulk, having better negotiations with your warehouse or your inventory management suppliers. And then you want to cap the cost to acquire a customer by channel. If CAC goes up for a certain channel, cut it right away. When it comes to thinking about growth, you need to rescope it. You need to fund channels that have a less than 6-month payback period. The best businesses that I've worked with have had a payback period of 14 days to 30 days when it comes to investing in cold traffic. That's huge. Those are the businesses that scale incredibly quickly because they know they can recycle their cash before their next billing cycle. You need to also consider the fact that you're no longer an investor and you're actually a hustler. So you have to stop thinking about long bets that take more than 12 months when you're trying to improve cash flow. When you're trying to improve cash flow, it's the same thing as the body trying to stay warm. All the blood goes back to the heart. So you need to keep the business to its core operations. And then once you're past 12 months of runway, 36 months of runway, then you can start thinking about those 12-month bets. Before that, don't do it. You need a cash war room as well. This means something that your CFO runs, maybe 30 minutes a week, an hour a month. It's something that needs to happen where you're doing a weekly cash forecast, you're doing a variance review, and you're making decisions that are logged and owned by certain people in operations and in finance. And then the communication is the last part, but it's also the most important part. Because if you cannot communicate to your whole team the plans that you're trying to make to improve the cash flow of the business, you're not going to get buy-in, and the whole company's morale is going to fall off a cliff. You don't want that. You want to remove ambiguity. You want to create KPIs that actually matter, that people can achieve. And you want to put timelines on those KPIs with the risk of getting fired. This is where you have to make it or break it. And this is something that most founders don't want to do because, you have somebody that's been with you for 5 years or 3 years or 2 years. And now you got to tell them, hey, do this or you're fired because I can't afford it anymore. That sucks. Now let's talk about what makes revenue quality good. This is what I call the revenue quality multiplier. So when it comes to measuring revenue quality, we want to assign multiples to revenue. And the way we do that is by accepting the fact that not all revenue is created equal. So this framework will assess the predictability and reversibility of revenue to set appropriate cash reserves and prioritize higher quality streams of income. This is the core concept. Recurring revenue beats project revenue every single time. If you have predictable revenue coming in, it's easier to plan your cash flow, reduce your risk, and lower the reserve requirements in your business. If you have unpredictable or reversible revenue like returns, you need a larger buffer to sustain that. Refunds kill e-commerce businesses all the time. Here's some data that I think might be helpful. The best B2B SaaS customer retention rate is 90%. Okay, like this is Salesforce, maybe even Facebook right? I don't know if they're doing B2B programmatic, but they probably are. The best in-class B2B SaaS customer retention rate is 90%. If you're a smaller SaaS and you target SMBs, you want a 7.5% monthly churn rate, which is 60% annualized, right? That's still a lot. E-commerce businesses, the refund rate and return policies, you want to target a little bit under 17%, and you want your returns to cost you 20 to 65% of the actual item value. So the way you price your SKUs is incredibly important. Customers who pay more than $250 a month on your products churn less because they have more integrations involved and higher switching costs. If you're an early stage SaaS, think about having a 6.5% monthly churn rate. And if you're doing more than $15 million, you want to have a 2% churn rate. Food for thought. This is some pretty good data that you need to consider when you're pricing your SaaSes and when you're actually managing the cash flows of your e-commerce businesses or SaaS businesses. When we think about revenue quality itself, we need to think about having a multiplier framework. So what does that mean? It means depending on how you get your revenue, you need to think about how many months you need based on that type of revenue. Some businesses have all 4 types of revenue, but in reality, this is just a small list and there's more versions of revenue than you can think of. And I'm going to basically give you the high level stuff that I think applies to most people who watch this video. Subscription revenue, you want to have 3 to 6 months of operating cash buffer. That means adjusting the churn rate, average customer value, and contract length based on how much cash it takes to sustain that customer, and also how much cash it takes to acquire a customer of similar nature. Longer contracts and higher customer cart values reduce the need to have a buffer. This is true in any business. In project-based revenue, you want to have 9 to 12 months of buffer because of timing variance and also higher cancellation risk. For e-commerce businesses, you want to model in all of your pro formas at least a 16.9%, but honestly 20% return rate. And you want to also apply 20 to 65% cost or waste hits to each return that you have. So of that 20%, 50% is a loss. So that means you want to set reserves to absorb that shock. From a portfolio view, $2 million in unpredictable revenue requires a larger war chest than $1 million in locked contracts. You need to weigh your buffers by revenue mix and volatility. This is why it's so important to understand that what you see in the media doesn't matter in real life. Headline revenue hides risk. You don't think about the quality of the revenue, the predictability, the retention, and the reversibility of that revenue. I know a guy who was doing, I think, like $5 million a month on an info product, and then he got hit with like $2 million in refunds in a week. Are you going to stay in business if you're doing that? I don't think so. So ignoring churn and return rates inflates your confidence as a CEO. It underfunds your reserve balance and it increases the odds of a liquidity crunch. So something you can do right now as a founder is segment your revenue by quality tier. Think about locked contracts, recurring but cancelable, project-based, and e-commerce as your scale, your sliding scale. You want to calculate weighted predictability using churn, contract terms, and return rates. You want to set cash reserve targets based on each tier. 3 to 6 months for subscription, 9 to 12 months for a project, and e-commerce needs to be adjusted. It's very, very complicated in e-commerce, but it's a good business model if you get everything dialed in. You want to prioritize your growth in the higher quality streams of revenue. That means saying no to some customers or pricing some customers out so that you can maintain the ones that actually value your business. And then you have to actively monitor your churn and returns monthly and adjust buffers as mix and metrics change. This is what it means to run a real business. You need to track all this data all the time. So let's move on to the dead zone calculation. When one customer makes up too much of your revenue, they actually become a risk to your business and they're not producing a good margin for you. Losing them could drain your cash fast. And I'm going to show you a calculation to show you exactly how much money you would lose if your biggest customer suddenly left. This is what concentration risk is. It means relying too much on a few customers for your money. It worries investors and it hurts your cash flow because one customer will create a massive gap. Here are some warning signs that you can consider when you're thinking about auditing your business's revenue. One customer that makes up more than 10% of your revenue is a red flag. If your top 5 customers make up more than 25 to 30% of your revenue, that's a red flag. If one customer makes up 20% plus of your revenue, that's a really big problem. If you have a high concentration, you will lower the value of your business by 20 to 40% simply because of the concentration risk in your business. So how do you calculate this dead zone? You need to think about what percentage of your revenue comes from your largest customer. You want to estimate how many months it would take to replace that revenue if they left. And then you want to multiply this formula. You want to take the monthly cost, depending on how we calculate this, is based on your P&L and how your CFO or your controller, your bookkeeper handles your chart of accounts. But essentially what we like to do is we like to look at direct COGS and direct labor. You want to look at your monthly costs and the time it takes to replace your dead zone. Okay. And this is how much cash you'd burn before recovering. So a simple example here is, let's say you make 12 million a year and you spend 800K. Your largest customer is 25% of that revenue in this example. That's 250K a month. It takes 6 months to replace that customer. That means you're going to burn close to $5 million, which is close to half your annual revenue from one customer. That's huge. 82% of these businesses fail because of that. Most businesses think that their business is going to decline slowly and then it will die and they'll have enough time to adjust. But the reality is it's like that. It's an instant and it kills companies. If you lose a 20% plus customer, it means it's an instant crisis. There's layoffs, unpaid bills, and failure. Here are some benchmarks that I think you can look at without going crazy. Try to keep any single customer under 10% of your revenue and make sure that your top 5 customers are under 25 to 30% of your revenue. After you get all of that, the next step after all of this is just to calculate your top 3 customers this week and think about it. Just take a moment, pause the video, think about all of this, because this is a lot of information, but it's very valuable. Another test that we like to do with our clients and portfolio companies is called the payroll test. The payroll test asks, if revenue went to 0 tomorrow, how many months could you make payroll without layoffs? This single metric reveals your true resilience in a crisis and your ability to make strategic moves instead of panic cuts. If you start cutting spend in places that you shouldn't, you don't have a contingency plan in place, your business will die very quickly, even if revenue returns. This is why payroll is so unforgiving, because you can delay vendors, renegotiate leases, and cut subscriptions, but payroll's different. The moment you miss it, nobody trusts you anymore. Your employees start jumping ship, they start looking for other jobs, morale is at an all-time low, people start putting in resignation letters, and your credibility collapses. And it makes it a lot harder to recover as a business owner if you lose your team than anything else. These are the numbers that actually matter. Payroll is often the largest expense, typically 20 to 30% of revenue for most businesses and 50 to 60% for service firms. Only half of small businesses have enough cash to operate for more than 15 days after a revenue disruption. What we like to do with our clients is do at least 60 days. Consulting firms fail at 80% within 2 years because of 30 to 90 day invoice terms while payroll is due immediately. Think about that. If you're running an agency or a consulting practice, you're probably going to fail within 2 years because your invoicing terms don't work for you and they don't work for your team. So here's how you can calculate all of this and at least get a grip of understanding where you're at. Your months of payroll coverage should equal the current cash you have divided by the monthly payroll. So if you have $300,000 in cash and your monthly payroll is $100,000, you have 3 months of payroll coverage. These are some benchmarks that you can use depending on your business type. 3 to 4 months for services. SaaS companies want 18 to 24 months, especially the ones that are playing on the J curve. And then consulting firms with long payment terms want 4 to 6 months minimum to cover just payroll. And the way you do that is by setting up certain treasury management systems like savings accounts, checking accounts, and then CDs and whatever and other assets that you can do to kind of cover that. But they should be interest-bearing accounts. I'm getting very detailed here, but there's strategies that you can use to make sure that your money's not just sitting there and being dead. But you do need to have these reserves in place so that your business runs effectively. The minimum operating cash threshold should be 6 to 8 weeks of fixed costs. There's different ways to define fixed costs, but you want at least 6 to 8 weeks. This prevents shortfalls from routine delays or one-off shocks. The businesses that didn't have any reserves during COVID, the first 2 weeks especially, were hit really, really badly. Having a cash buffer just for payroll allows you to have time to reprice, refocus, or reduce scope for your clients without having layoffs immediately. This is huge. It allows you to renegotiate terms with your vendors, secure financing, or launch emergency offers. You preserve the culture in the business and your customers trust you more while you change course. Here are some things you can do to improve your coverage ratio. You want to freeze hiring. That means prioritizing high ROI roles, things that companies are doing right now, and projects. You want to build a dedicated cash reserve system for payroll. You want to shorten cash cycles, Align your payables with your receivables, meaning when you get money, you pay the money, not you pay the money and then you get the money. That sucks. You want to tighten your variable spending. You want to pause non-critical tools and marketing, strengthen your collections process, have automated reminders, late fees, and discount your customers for early prepayments. That one is huge. We have so many of our clients that prepay us and we give them the discounts. Sometimes it's even a tax benefit for doing it. You want to strengthen your collections doing that. You want to have a line of credit, not one that you draw against, but one that you have just in case before you need it. And I'll explain why in the next slide. You want to do monthly scenario planning, update your cash flow forecasts, and stress test revenue drops. Always stress test your revenue. It's not going to be the same every month. And adjust your pricing based on that, based on each scenario. This is how you can improve your margins for the long term. When you convert your bonuses for your team to performance-based bonuses, things improve in the business. And you want to also defer discretionary payouts. That means as a shareholder, you're going to get paid last. I know it sucks. I deal with it all the time, but leaders eat last, and that's just how it is. So you should do this payroll test monthly, if not quarterly, and make decisions to increase coverage or decrease it. In a crisis, this is the metric that will matter the most. And let's talk about lines of credit and debt capacity. Many founders miscount their undrawn credit as liquidity, but in downturns, those lenders will pull back and credit capacity actually disappears. This is the trap. I can't stress this enough. Just because you have a line of credit doesn't mean that you have it. You have possibly some debts, some interest payments, and you're calling that your war chest. This can't be further from the truth. There's a ton of banks right now that, don't want to mark to market their assets because they know that the refinance is on all those assets. This is a problem that founders and banks and lenders and everybody faces, but credit lines disappear when there's a crisis. Banks don't want to mark their assets because they don't want to show losses. Founders don't want to refinance because they're going to get a higher rate that'll put them out of business. Using lines of credit matters, but believing that that's your safety net is a losing strategy. In a crisis, your capacity for credit will disappear exactly when you need it. And this is exactly what happened in 2008. Small business lending declined by 116 billion. That's 18%. Four of the largest banks sharply cut small business lending and depressed it until 2014. That's 6 years. You're going out of business. In 2008 of October, SBA loan volume was less than 50% of its lending volume 12 months earlier. So the SBA isn't your friend. They'll just stop lending if there's a crisis. By 2013, inflation-adjusted small commercial and industrial loans were less than 80% of 2007 levels, and almost 500 banks, 500, were closed during 2008 to 2012. They often pulled their credit with them, the ones that they were giving their customers. The same thing happened in 2020. We had approved undrawn credit lines that were frozen, reduced, or pulled as lenders retreated. Credit availability dropped procyclically, meaning lenders lost funding and exited the market precisely when businesses face revenue shocks. This is a rule you need to follow. Only count debt capacity that's already drawn and sitting in your account. Everything else is a fair weather friend. It's not going to help you in a crisis. Credit lines inflate your perceived runway and liquidity. Founders are forced to make hard decisions when they don't want to because they're delaying it when they have it. So you're like, oh yeah, I have a great line of credit. I can delay a decision or a layoff, or maybe we'll give this guy another month to perform. No, the moment that crisis hits, that's it. It's over. You're just going to start making an emergency decisions with fewer options and higher costs. So here's what you can do. Draw down your credit lines preemptively if you sense the market's about to go through a rough patch. Pay the interest because you're getting optionality. Recalculate your runway and liquidity coverage ratios, excluding your undrawn credit facilities. Treat your credit as an upside, not a baseline. Secure term loans or committed facilities with strong MAC clauses and limited pull rights. That means that you can keep your credit because of contracts, certain things that banks extended that make them go under, but you as a founder want to take control of that. You don't want to rely on revolvers. You have to stress test your liquidity, assuming zero access to new or undrawn debt. And you want to build cash reserves from operations or equity, not from the promise of future borrowing. That is a losing strategy. The bottom line, undrawn credit is not an asset. It's a contingent liability that evaporates in downturns. You need to plan as if it doesn't exist And that's the way you'll avoid being caught off guard. So let's move on to liquidity coverage ratios, the final slide in this video, but considerably one of the most important ones. Banks have to do this. You have to do this. It's a simple test. It's something that you should check every month to make sure the business is running appropriately. You have to understand that banks need to hold enough liquid assets to cover 30 days of cash outflow. But most businesses don't even measure this need, and it creates a critical risk for most founders. The LCR, liquidity coverage ratio, gives a clear 30-day view of whether you can meet obligations without new revenue or financing. And this is a huge problem. 38% of startup failures are due to cash depletion. I cannot stress that enough. 23% of startups fail within their first year because of insufficient cash reserves. In e-commerce, 29% of small businesses fail because they run out of cash. Doesn't mean they weren't making sales, but something got locked up in the payment processor and they have to wait 120 days, not naming names. 16.5% of online sales are returned, which means you need to have cash ready to sustain that loss. That tightens your working capital and makes you less rich than you think you are. The liquidity coverage ratio is a way to measure how liquid you'll be in a crisis. You need to calculate your liquid assets and divide them by the cash outflows that you have, both for the next 30 days. Here's how you calculate it. Add the cash in your bank plus all the assets that you can sell at face value within 30 days. That doesn't mean inventory. That means things that you can sell, stocks, bonds, CDs, treasuries, commodities, whatever it is, things that you can sell within 30 days. Total all the cash outflows due in the next 30 days. Payroll, rent, COGS, debt, taxes, whatever it is. You got to total all that up. And then you got to divide both of them by each other. What counts as liquid? Let's go back to that again. Cash in the bank, money market funds, marketable securities. Don't include inventory because that's your whole business. Don't include receivables because people need to understand that people pay late. People don't pay on time. Don't include equipment and don't include slow moving inventory. It's a cash drain. Unsold items tie up your capital. They're not part of how you consider yourself liquid. I'm going to skip this comment because my assistant really screwed up here. I don't know what she was talking about, but yeah, she needs a strong verbiage too. But essentially, when it comes to inventory management, turnover depends on the products that you have. This is a rookie mistake that I'm going to have to correct, but hey man, it's in the slide, right? As I said, generic data. Anyways, here's an example calculation. You have cash on hand of 150K, securities that you can sell in 7 days of 50K, meaning your liquid assets are 200K. In the next 30 days, you're going to spend 180K, which means that your liquidity coverage ratio is 1.11, right? 1.11. Anything below 1 means you can't cover the next 30 days without new revenue or financing, which can put you at risk. It is probably a crisis. You're probably feeling very stressed out if you can't do that. Here are some ratios to interpret your LCR. Basically, 2+ is great. You know, all the companies that we work with, we stress test this every month and we want to make sure that we're above 2. This matters a lot because your total assets or the total runway in your business don't matter. Liquidity is about speed. If you want to budget without having to do a 13-week cash flow forecast or model, which most businesses do anyways, you need to make sure you have the right liquid assets being accounted for. It's about speed. If you can't convert your assets to cash in 30 days, you don't have an asset, you have a liability, honestly, sometimes. So these things won't fund your payroll when you need it the most or when bills are due next month. So you have to make sure that you can liquidate your assets in 30 days. Here's something you can do today. Calculate your LCR. If it's below 1.5, you have no margin for error. Don't accept anything less than 2. Try to get yourself to a 2. Improve your LCR by increasing your cash, accelerating your collections, reducing your near-term outflows, and liquidating the slow-moving inventory. That might mean discounting things. That might mean selling things off for pennies on the dollar. But this will prevent you from having problems in the future. I know this was a lot. This is close to an hour-long video. It's one of the longest videos I've done yet. But I really wanted to make sure I put all of this into one video so that you could understand how we think about revenue, how we think about how big your war chest should be, because I've gotten so many questions about this and people booking consultations and one-on-ones. But for your business, if you want a consultation or a one-on-one, click on the link in the description below, like and subscribe, and I'll see you on the next one.